Today we're going to take a little break out of the case studies and we'll have some fun discussing the history of insurance. Discussing the history of insurance really, I feel, helps us understand exactly what insurance is. It helps us conceive of what we're participating in when we participate in a life insurance contract. So we'll start right from the beginning. We'll move really quickly to the present day, and we'll take a little tour along the way. So insurance started with the Phoenicians, and the idea with the Phoenicians is they were seagoing people. And of course, when you're a seagoing people, you're taking vessels across the sea. And there's a lot of risk. And that risk is that there's going to be some kind of storm and that ship is going to sink. And we didn't want one person to take on all that risk. So we would have a collective group all participate in that voyage. And they would have a contract whereby if that ship went down, it wasn't going to be one person that was going to bear all the costs. It was going to be the collective that would bear all the cost. So what we see here really is one person is taking a risk in sailing this ship across the sea. That's too much risk for that one person to take, because if the ship goes down, they're completely devastated. They don't have any money left. So what we do is we take that risk that that one person is facing and we spread it over a number of different people. Because even if all of these people were taking ships across the sea, the likelihood of all 1, 2, 3, 4, 5, and however many people are in there, maybe there's 30 people in there, the likelihood of all 30 ships going down at once is not that great. But the likelihood of one ship going down out of 30 is significantly greater. So what they've done is they've managed to spread out that risk over all of these different people, over all of these different voyages. So the whole idea with insurance from the beginning was to spread out the risk. Spread out that risk that is going to affect one person at one time, but not affect the whole group at one time. So I would suggest that that's an asystematic risk. So it's not going to affect everybody, but it is going to affect one person. It's likely to affect one person. So how do we manage for that? We pool our money together, and if any one of these people is hit by their ship going down, they're only going to have to pay 1/30 of the money instead of all of the money associated with that loss. That is the basic idea behind insurance. And let's move forward. So later on, that idea was used for people's lives. So the idea of one person dying at any single moment is quite likely. One person is going to die probably within the next hours, one person somewhere. But the likelihood of a group of thousands of people dying at any one time is not that great. So right from the beginning, insurance policies were set up that there would be a pool of people. And all these people would put their money into the insurance policy. And if one of those people were to die, then that money comes out to that person's family. And there's some women in here too. There may not have been at that time, but there is now. So it goes to the family of that person. And this family, as a result, maybe it's going to be tough for them going forward, but they're not in quite the same financial situation that they would have been if this person didn't participate in this pool of insurance. So that's the way it went for a long time. And then we came to, I'm skipping a lot of the history, and we're going into more modern day times. We're going into basically the 80s, the 1980s. In the 1980s, oh, and I should say too, that this pool over time would be invested. So all of these people inside the pool would participate in the fact that that money increased over time. The value of that money in there, or the amount of money that's in there, increased over time. In the 1980s, what happened is that we saw a stock boom. So we saw a huge bull market. And people were in these kind of insurance policies where they were getting a rate of return, and maybe that rate of return was somewhere between 10 to 15%. And what they noticed is that, hey, if I just put my money in the stock market, of course the stock market is going up, say 30% a year. So why do I want to earn this 10 to 15% in my life insurance policy when I could invest it? And not to give too much merit to Primerica, but Primerica was a big advocate of buying term insurance and investing the difference. So this way you could get the insurance cheap, and you would get these great investments on your money of 30%. Why wouldn't you do that? Why wouldn't you split those up? So we took the insurance policies that used to be investments and insurance, because we were pooling our money, and if we died, we had that coverage, and we split the two elements of that out. So we split out the insurance and we've already got investments. So, and you would put that into something called a mutual fund, because of course you're going to make a lot of money in mutual funds. So that's where the industry went at that point. These two things were split out, and we get a lot of people from that era really who don't like this kind of insurance, because they had the realization that, hey, you could just cut out this insurance, make it a lot cheaper, and make a lot more money somewhere else. So that's where we get a lot of that attitude, and it made sense at the time that really you want to get the cheapest insurance possible, and you want to find some other place to do your investments, because insurance really isn't the place to do your investment. Buy term, invest the difference. That was the slogan. Buy term, invest the difference. So the insurance companies didn't necessarily want this situation. All of a sudden, half of the money is going out of the policies. So they had to figure out a way that we could retain these assets and give people the possibility of splitting out the insurance and the investment. And that's where Universal Life comes in. Universal Life. So with Universal Life, we're going to make an insurance policy that has a term component and has an investment component. And you can invest that money wherever you want. They give lots and lots of different options of where you're going to invest your money. Back here in these policies, It was just managed by the insurance companies. You had no choice where that money was going. Here, now you can buy mutual funds in here. Or if you wanted to take a less risk, you could put the money into the insurance form of GICs. And don't forget, back in the 80s, we were seeing GICs at north of 15%. So even the GICs looked really good in the universal life plans. So nobody, again, wanted to look at these because they had no options. We knew if we just put the money in the stock market in a mutual fund, we're going to make an incredible amount of money, obscene amounts of money. So why would you even ever leave it here? We're going to either buy term and invest the difference or put it into a universal life policy. So after that, we saw that stock markets and the returns can come to an end. And the 2000s were a good example of that when we had the dot-com bust. 2008 was another good example of that when it was 2008. Those are two examples where we saw real stock market crashes. And what we did as a result is we've moved back to this model. So we've moved back into those collective pools. And those collective pools have actually generated good returns over time. If you look at the dividend rate that we've got right now, it's about 6.25%, and it comes with all sorts of guarantees. So people now like this kind of return. Maybe it's changing with the way the stock market went last year, but from what I see out there in general, people want some stability somewhere. So we're back to the collective pools, and we're back to putting money into an investment where it's both got the investment component to it and the insurance component that are the same thing. We've got a pool, and part of that pool will pay out if one of us were to die. Rather than splitting out the insurance, either buying term and investing the difference in a term and a separate investment account, or rolling everything together in a universal life. So I hope that was helpful. I hope that helps you understand the way insurance works a bit and the different types. Essentially, we went over 3 types: term, universal life, and I don't think we ever said it, but this last one, this collective one, is a whole life policy. So those are 3 different types of insurance and how they came about historically. Of course, this was the first one, this was the second, this was the third, and just where we are right now, it seems like most people are happiest with this one. We'll talk to you on Monday. Thanks, guys.